Hello and welcome back to The Note. People are beginning to lose confidence in Abenomics. When Shinzo Abe was elected some 18 months ago and announced his big programme of economic reforms, it sparked a big rally in the stock market and a sharp fall in the yen. Now there appear to be second thoughts, and according to my guest today, there are good reasons for those second thoughts. He is the chief economist at Lombard Street Research here in London, Charles Dumas. Charles, thanks very much for joining me once again. Let's start by taking a look at the pattern of real wages and jobs in Japan. Plainly, one of the most important aims of Abenomics would be to see real wages start to rise, but they're falling. What's going on?
Well, what's going on is that Abenomics unfortunately exaggerates an already excessive flow of income into business and takes it away from households, as any devaluation will tend to do, and devaluation was an absolutely crucial part of the Abenomics program.
Okay, now devaluation did actually happen, obviously, and it should help exports. Let's take a look at export performance. This is a chart you've produced. How did you come to these numbers, and how can Japan be faring quite as badly as this, given that it does have a devalued yen?
Well, the chief reason, I think, is that Japanese businesses have too easy a time with all this easy cash flow.
Right.
But that's the sort of motivation. But if you want to say what is it that sort of constitutes this in concrete terms, you would say something like 30 years ago what we used to buy was a Sony Walkman.
Right.
It was a Nintendo Game Boy. It was a Sharp fax machine. It was a Toyota or a Honda car.
And now it's something American produced in Korea or wherever.
You only buy Japanese stuff if it's so cheap you can't resist it.
Okay, this is all rather discouraging. Now let's take a look at where Japanese GDP is, and the big difference compared to the US is the amount of money that's pent up there within companies in depreciation and retained profits. How do you deal with that problem? That must be one of the critical issues that Abenomics has to deal with.
Well, unfortunately, Abenomics does exactly the opposite. It actually redistributes income away from the already insufficient personal disposable income towards businesses, because first of all, the devaluation shifts income to business from people, as we've seen, because prices go up largely because of import prices, in fact entirely. And secondly, the consumption tax increase that was scheduled before Abe came to power was kept in place, and he's now announced some reductions in corporation tax to offset it in order to make sure that the economy doesn't collapse.
Which is a net transfer of the burden from the corporate sector to households.
Exactly. So the situation when we get, these are 2012 numbers, the latest numbers the Japanese have done thoroughly. When we get to 2013 and again in 2014, this bias will be worse, not better. So
what do we do now, or what does the Abe government do at this point? Is there anything beyond simply trying to devalue the yen still further?
The most important and satisfactory one will be actually to directly approach the issue at hand, which is too much corporate money, which is very much connected to the fact that they have these very strong interlocking shareholdings. Only a small proportion of shares are owned by households directly, quite a lot by foreigners, but mostly by one another. And so they don't have any need to distribute the money, because it only just goes to one another. And the depreciation rate also is extraordinarily high, because partly because GDP is hardly grown, but also because depreciation allowances are too lavish. So I think what they need to do is sharply curtail the depreciation allowances and then introduce essentially punitive tax rates on retained profits, a zero tax rate on distributed profits, and make the retained profit high rate apply to any distributions to corporations as opposed to households.
Okay, that's a radical package. What kind of chance would you put on that actually happening?
Well, I mean, in private eye, you'd probably say not unadjacent to nil.
Right.
Would be the and so the first and second alternative policies, which are what they're actually pursuing, is trying to get out of a structural problem with a monetary means, which invariably doesn't work, as people from the Bundesbank would tell you over decades. The two alternatives really are either to devalue further substantially, which of course wouldn't solve the problem, but it would create some growth in the short run. It would finally get the exports going. It would scare consumers and cause them to spend a little money. Might even stimulate capex a little bit further. But of course, once you get to inflation to 2%, which is the target, then you have to say to yourself, okay, well, we've got this quantitative easing, which is well over 10% of GDP. That can stop now because we've hit our target. At that point, the Japanese government bonds will move from yielding 0.6% now to some number like the real yield they had before of 1.5% to 2%, which would of course be 3.5% to 4%.
So my final question, does that really imply that we are heading for a financial crisis in Japan?
I think the answer is probably yes, if they pursue further devaluation, because what has protected them from crisis so far has been the deflation and the low interest rates resulting.
Charles, thank you very much. Not that that was a very positive prognosis, but it has to be taken very seriously. People tend to regard Japan as an exception to all rules. It tends not to be looked at as closely as it should be. It remains the world's third largest economy. It needs to be viewed very carefully indeed.